Welcome to The Explainer. Today, we're going to pull back the curtain on a company's finances. We're going to look at the hidden side, the part that shows potential windfalls and, yeah, even some ticking time bombs that you won't find on the main balance sheet. They're called contingent assets, and trust me, understanding them is one of the keys to seeing what a company's future really looks like.
All right, let's just jump right in with a scenario. Imagine your company's in the middle of a lawsuit. Your lawyers, they're feeling good. They're telling you it's a slam dunk. You have a 95% chance you're going to win $1 million. So the big question is, can you go ahead and book that $1 million as an asset on your financial statements right now? I mean, it feels like you should, doesn't it?
Well, according to the very strict rules of accounting, the answer is a hard not yet. And the reason for that not yet is actually super important. It gets to the very core philosophy of financial reporting, a philosophy designed to protect everyone from hype, from optimism, from wishful thinking. Getting this is your first step to reading financial reports like a true pro.
So if that potential $1 million payday isn't a real asset yet, what in the world is it? Well, accounting has a special name for this kind of thing. It's what we call a possible asset. Let's break down what that actually means.
Okay, here it is, the official definition. But don't let the language scare you. Just notice the three key pieces. First, it's a possible asset, meaning, hey, it's not a sure thing. Second, it comes from past events, like the lawsuit actually being filed. And third, and this is the big one, its existence is only confirmed by future events that are not wholly within the entity's control. You can't just decide you've won the lawsuit. A judge has to do that.
This chart right here makes the difference crystal clear. Look, a standard asset, think of a factory or a delivery truck, is something you control. Right now, it exists, and because of that, it's right there on your balance sheet. Now, a contingent asset, it's pretty much the polar opposite on every single point. You don't fully control it, it doesn't officially exist yet, and so, and this is key, it is strictly prohibited from being on the balance sheet. This distinction is everything.
Now, this rule, this prohibition, it isn't just some arbitrary decision. It's actually rooted in a really deep, guiding principle of accounting. It's a principle that intentionally treats potential gains and potential losses very, very differently.
And it all comes down to this one core idea: prudence. You could also call it caution or conservatism. The entire system is built with this conservative bias on purpose. And the goal is incredibly simple: prevent companies from reporting income that might never, ever show up. Because, let's be honest, you can't pay your bills with a maybe.
Okay, this slide, this is the big aha moment. Just look at the difference here, the asymmetry. Over on the right, for a potential loss, a liability, you have to record it as soon as it's just probable. That's basically a little over a 50% chance. But now look at the left side, for a potential gain. You can only book that when it's virtually certain. That is a much, much higher hurdle to clear. So to put it simply, you recognize losses early and you recognize gains late. That is the principle of prudence in action. So, if you can't put a potential win on the balance sheet, where does it go? Does it just vanish into thin air? Not exactly. Let's trace the journey of a contingent asset, from being just a distant possibility to becoming actual cash in the bank. It's a journey that really unfolds in three clear stages. Stage 1, when a win is just possible, less than a 50-50 shot. You do absolutely nothing. It's not mentioned anywhere. But once the odds get better and it becomes probable, you hit stage 2. You still can't book the money, but now you have to disclose it in the footnotes of the financial statement so investors can see it. And finally, when it becomes virtually certain, the judge's ruling is final, the appeals are over, only then do you get to stage 3 and finally recognize it as a real asset on your balance sheet. And here is that exact rule playing out in the real world. This is from the tech company C3.ai. They're going after a massive 2.1 times billion euro lawsuit. But just look at their official filing. They are following the rules to the letter. They're saying, look, even though we're chasing this huge claim, we can't predict the outcome yet, so we won't recognize any gain until it's a done deal. This is exactly what prudence looks like in practice.
Now, here's a really critical detail, especially for anyone looking at global companies. That little word, probable, it actually means different things depending on where a company reports. Under international rules, IFRS, it just means more likely than not. So over 50%. But under US rules, GAAP, it's a much higher bar, closer to a 75% probability. And the key takeaway here, it means a US company might actually wait longer to recognize a potential loss than a European one would, which could make its books look a little bit healthier for a bit longer. It's a subtle difference, but a really important one.
So because all these rules rely on human estimates, people guessing at probabilities, they're also subject to our very human flaws. And this is where true financial analysis begins. It's about looking past the numbers and thinking about the judgments that were made to get them.
Right. Because these are just estimates, they can be vulnerable to all sorts of human biases. Management might fall victim to optimism bias, just really hoping for the best. Or maybe they get stuck on an initial number they thought of because of anchoring. So when you're reading one of these reports, you have to remember that the probabilities you're seeing, they aren't pure mathematics. They've been filtered through these very human and very common tendencies.
And the scale of these judgments can be absolutely staggering. This isn't just some small academic point. In its 2024 financial report, the U.S. government itself disclosed that it has $51.9 times billion in liabilities that it has judged to be probable. These are for things like legal claims and environmental cleanups. Think about that. The judgment call on that one single word, probable, has a nearly $52 billion impact.
And all of this brings us to what I think is the single most important lesson from this entire explainer. The big numbers on the balance sheet, they tell you what is certain. But the notes, the footnotes buried in the back, they tell you what is possible. They contain the story, the uncertainties, and the potential future events that could completely change a company's fortunes. The real story is so often hiding in the text.
So the next time you open up a financial report, please don't just glance at the big numbers on the front page. Dive into those footnotes on contingencies and ask yourself this question. What story are these notes trying to tell me? Because answering that question, well, that's the difference between just reading financials and truly understanding a business.